Hello students, in this video we will learn how to calculate the cost of debt. First let me tell you what is the importance of calculating cost of debt. We need to know the overall cost of capital for the firm. So overall cost of capital is the weighted average cost of capital for the firm, which is required to know the minimum that a firm should get a return from all its investment and all its project. So this cost of capital or weighted average cost of capital is the minimum expected return that a firm should expect from investment, right? So this cost of capital is weighted average of the overall cost of capital for the firm. So overall cost of capital means the cost from various sources of capital for the firm. So what are the various sources of capital for the firms? They are basically three type of sources from where firm can procure its capital. So broadly they are classified as the debt or debentures, or the preference share capital, or the owners shares that we call as equity share capital, or the retained earning. So finding the cost of these three sources of fund is what is the cost of these three different sources of fund. When we come to know the cost of these three sources of fund, then we can calculate a weighted average of these sources and can find out the overall cost for the firm, that is the cost of capital for the firm. So we will be studying these three cost of capital, that means the cost of debt, cost of preference shares and the cost of equity shares in our 3 sessions. But in this session we will be focusing on just the calculation of one important source of capital, which is from debt or debentures. So debt is the financial obligation for the firm. That means a firm has procured the money in the form of borrowings, for which they have to give a predetermined fixed rate of interest. So for calculating the cost of debt, one may think the cost of debt may be the interest that the firm are paying, right? So the quoted rate of interest, let's say a bank loan at the rate of 12% per annum. So 12% will be the cost, but it is not be the cost, because cost is what actually the firm incrementally has this cost in its capital structure or in its profitability statement. We will see then how to calculate this cost of debt in the form of a formula, and also the numerical illustration of how to calculate cost of debt. For calculating cost of debt, we will be taking three various type of debt and the three various type of debts features. So debt or debenture, if I say, they are one or the same thing, because debt may be from family friends, from banks. Bank loans are also debt, and it can be from public like debentures or fixed deposits, or in the form of the bond. The calculation of cost of these debts are similar. So here what we are doing, we are classifying these debentures or debts into two categories. Either it may be redeemable or it may be irredeemable. When I say the irredeemable debt means the maturity amount, where the firm has to give back the amount to the holder, to the creditors, is not fixed. So such debts and such loans are irredeemable debt. But when a maturity amount is also being specified, like in case of most of the bonds or most of the debentures, the maturity amount is also fixed. At the maturity, the firm has to give back the money, the loan amount, borrowings to the lender. So such debts are redeemable debt. So we will be learning here the calculation of both the type of debts, either redeemable or irredeemable. When it comes to irredeemable debt, there may be two type of debts, because here the redemption is not there. Firm is not going to redeem in near future, in long term also. So there may be two type of debts: the debt which are issued at par. At par, when I say, that means which are issued at its face value, the value which is written on the document, which is the face value, par value of that particular instrument. Debt instrument may be debenture or may be bond. So the face value is the par value. If it is issued means if the firm is giving these debt to the public, issuing these debt to the public or to financial institutions at that price only, which is the face value. So, we say the cost debt is issued at par, but it may not be always the case. The debt may be issued maybe at discount or maybe at premium also. So, if it is at discount, that simply means that firm is giving some percentage discount on the face value. So, for example, firm is giving 5% discount. So, 5% discount means if the face value is 100, so 5% will be deducted from the 100, as we have a sales in our physical market also. Similarly, discount means firm is giving a relaxation of those percentage in terms of discount. So, in this case, firm will be getting what amount? 95 rupees. The face value is 100 per debenture, but firm will be getting only 95 rupees because it is issuing it at a discount of 5%, right? One case. Second case may be if the firm issues these debentures at premium. Right, at premium means for example, the firm is very confident about the launch of its debenture. The company enjoys a very good goodwill in the market. So, if it sells its debenture at a rate which is higher than the face value, then we say the firm is issuing the debenture or the debt at premium. So, for example, firm decides to get 5% premium by issuing its shares. So, if the face value is 100 and 5% is the premium, that it will be sold in the market at 105. So, firm will be getting what? The net proceed for the firm will be 105 rupees per debenture for the debenture whose face value is 100. तो 100 रुपए की चीज़ 105 में बेच रहे हैं तो इट इज़ इन एट प्रीमियम, और 100 रुपीज़ की चीज़ अगर कम में बेच रहे हैं तो इट विल बी एट डिस्काउंट. सो द कैलकुलेशन विल ऑल्सो बी डिफरेंट. So, we need to first understand these different cases, if the firm issues at discount or issues at premium, और कई बार जब हम redemption की बात करते हैं redeemable shares की, then redemption can also be at a discount, at premium, depending upon the position, the scenario of the firm in the market amongst the investor, right? So, let us see the calculation part. First, we will see the cost of debt at par, and this is for irredeemable debt. That is very simple. The formula is KD. KD here stands for cost of debt. So, KD is equal to I, here is interest, 1 minus T. I is the interest rate. So, we will be taking here the rate. And why 1 minus T? Because as I told you in my earlier discussion also, that interest is a tax deductible expense. The firm is saving something on tax if it is giving interest. So, interest is an expense which will reduce what? Total taxable income. So, firm is saving something on tax, or how much it is saving? Obviously the marginal tax rate. So, जितनी saving हो रही है firm की, हम अगर उसका consideration ले, so that's if we deduct that saving, then the cost of debt will be interest 1 minus T, right? So, the formula will be interest 1 minus T for irredeemable. So, you will have to check in the given situation whether it is redeemable, it is irredeemable debenture, and then you have to see which formula to apply. So, if it is irredeemable and issued at par, so simply you will say interest 1 minus T is the cost of debt. Let us see an example. Here the company has issued debenture with coupon interest at a rate of 10%. I am writing here coupon interest. Coupon interest means the quoted rate of interest which is fixed, which a company is going to give during its having it debt, right, till it redeem or till it has every year has to pay a fixed rate of 10% as interest, which we say as coupon interest or the quoted interest rate. Face value of the debenture is 100. Face value means the price of this debenture is 100. Then find the cost of debt if the tax rate is 30%. Very simple. We will take interest rate here, not the interest amount. So, we will simply write 10% and we will take this tax deductible expense part as consideration. So, 1 minus 0.3, 0.3 is 30%, right. So, I can write 0.3 for 30%. So, 1 minus 0.3 is 0.7. If you multiply it by 10%, so the cost of debt will be 7%. It is that easy, right. So whenever there is a bank loan or debenture where the maturity or the redemption thing is not given to you, then you have to assume it as a irredeemable debt and then apply this formula given the tax rate. Now look at the another case where the debenture or the debt is irredeemable, but they are not issued at par. They may be issued at discount or they may be issued at premium. So we know what is discount and what is issuance on premium. Here the formula will be modified. So instead of just taking interest rate, what we will have to do here, we will have to take interest divided by net proceed. Now what is this net proceed? Net proceed means the amount which the company is going to have in hand by issuing this debenture. तो जितना एक डिबेंचर या एक बॉन्ड को इशू करके जितने रुपए हाथ में आएंगे कंपनी के, that is the net proceed. So obviously if it is at premium, the company will be getting more than face value. If it is at discount, company may be getting less than the face value. So net proceed per debenture will be different. So what we are going to do here, we will write interest amount here, not the interest rate. The interest amount means on one debenture what will be the interest amount divided by the net proceed of one debenture at the time of issue, 1 minus T. So this formula will be modified. One more important thing to be noted down here is that when we calculate net proceed, then you also have to take into consideration the expenses also, because when a company issues debentures or bonds, they have to undergo certain expenses like brokerage, commission, all these things. So such expenses should also be taken into consideration for net proceed, calculating net proceed. Obviously, because that amount you will have to expend, so you will not be getting it in your hand. So net proceed will be different. So we will illustrate it with the help of an example. So here the company has issued debenture with coupon interest rate of 10% at a discount of 5%. Now look here, we are talking about a discount. So at a discount of 5%, face value of the debenture is 100 rupees. Find the cost of the debt if the tax rate is 30%. So what is given, just be careful about that. Here the debenture is irredeemable. Coupon interest rate is 10%, but it is issued at a discount of 5% where the face value is 100. So if the face value is 100, 5% we are giving as discount, so obviously the net proceed will be 95 rupees. No expenses are given, so we will not take expenses into consideration. Tax rate is 30%, so we will simply write 10. Cost of debt is equal to 10 divided by 95 multiplied by 1 minus tax, which is tax rate is 30%. So I am writing 0.3 here. So your cost of debt will be 7.36% in this case. So this is irredeemable debt issued at discount. Similarly, if irredeemable debt, if it is issued at premium, then instead of subtracting the amount, the percentage, we will add it to the face value, because this is the amount we are getting more than the face value. Look at this example. Company has issued debenture with coupon interest at 10%, premium 5%, face value of the debenture is 100 rupees. Find the cost of debt if tax rate is 30. So now here what we will do, the interest is 10. 10 means 10% on face value. Interest is always calculated on face value, remember that. So 10% of rupees 100 is 10 rupees is the interest, and the net proceed in this case will be 105 rupees. Why? Because it is issued at a premium of 5%, right? So 10 divided by 105, 1 minus tax rate, which is 0.3, is 6.66%. Now the cost of debenture has reduced here. Look at this example, 7.36 and here 6.66, where the face value is same and the interest rate is same and the tax rate is same. Why? Because now we are getting more amount, but we are paying interest at 10%, so cost for the company will be less. This is how we calculate for irredeemable debenture. Now come on to the next method, which is cost of redeemable debenture. So we have a approximation formula to calculate this, right? I have written a formula here. Cost of debt is interest 1 minus t plus RV minus NV divided by N, the whole divided by RV plus NV divided by 2. That means the average of redemption value and net proceed. This may seem complicated, but when you look here in fractional form, it is simple to learn, simple to understand, and simple to apply also. What we are doing here in approximation, now we have the redemption value also, because these are redeemable debentures, right? Redeemable debt. So we have redemption value also, we have net proceed also. We have to take the both thing into consideration, and then we will be able to calculate the cost of debt for the period for which the company enjoys these debt, having it in their capital structure. Interest 1 minus t will be here. So in fractional form it is not written, but we will take 1 minus t here, plus redemption value. So redemption value is the redeemable or redemption value of a debenture. Now again, you have to take into consideration, you have to take or be careful about whether these redemption will be at premium or it will be at discount. So that amount we will be taking, and remember, everything we are going to take per debenture, right? So that the calculation is simple. Even if you take for the whole amount, the calculation will be bigger, the amount will be larger. So we will take one debenture, that is okay. So redemption value is the what a company is going to pay back per debenture. Net proceed, we know what a company is getting in hand per debenture. That means the face value plus minus the discount or the premium, and also the expenses. And here is the number of years in which debenture is to be redeemed. Then RV plus NP, net proceed, divided by 2. So this is how we calculate. We will look at the illustration of example. ABC Limited issues 12.5% debenture. That means the interest rate is 12.5% of face value of rupees 100 each. Face value is 100, interest is 12.5%. Redeemable at the end of 7 years. So after 7 years, they are going to redeem this debenture. So N here is 7 years. The debenture is issued at a discount of 5%, right? And the flotation cost is 1%. If the interest rate is tax rate is 40%, find the cost of debenture. Simple. We will put all the inputs into the formula. Now if you understand the formula, interest is 12.5% of what? 100 rupees. So 12.5 rupees. Look here, the second last line, 12.5 is the interest, 1 minus 0.4, because tax rate is 40%. So I am writing 0.4 here. Now redemption value. So nothing is given whether it will be redeemed at discount or it will be redeemed at premium. So I am taking here as it will be redeemed at par. तो जो face value है उसी पे redeem करेंगे. That means 100 rupees. Now minus the net proceed. So how do we calculate the net proceed? Look here, I have calculated net proceed per debenture for you. So it is 100 rupees, which is the face value, minus discount. How much discount? 5%. So 5% of 100 rupees, rupees 5 as discount I will deduct here. Then also the flotation cost of 1%. Flotation cost is the expense of issuing. So expense is 1%. 1% of what? 1% of rupees 100. So rupee 1 will be expense. So अगर ये 5 और 6 rupees minus करते हैं तो 6 rupees will be deducted and company will get 94 per debenture in cash in their hand at the time of issue. So I am taking net proceed here as 94. So I am putting it in the formula, 100 minus 94 divided by 7. Why 7? Because the maturity year is 7 years. 100 plus 94 divided by 2. If you solve this, you will get 8.61% as the cost of this redeemable debenture. Right? So, my dear student, what you need to keep in mind, you have to first check whether it is a redeemable or irredeemable, or अगर redeemable, irredeemable पता चल गया आपको, then find out whether it will be issued at par, at premium or discount, or it will be redeemed at par, at premium or discount, what is the flotation cost or the expenses, and then remember the formula, put it in the formula, you will get the cost of debt. I have taken another one for you also. A company issues 10% debenture of face value of rupees 200. 10% is the interest rate, 200 is the face value. Redeemed at the end of 5 years. So 5 years is your period. The debenture is issued at premium of 5%, flotation cost is 1%. If the tax rate is 40%, find the cost of debenture if it is redeemed at a discount of 10%. Now look here, it will be redeemed at a discount of 10%. So here both the redemption value and net proceed you will have to calculate. So redemption, they say it will be redeemed at a discount of 10%, 10% of 200 now, because the face value is 200 will be 20 rupees. So it will be redeemed, what amount will be redeemed? 180 rupees per debenture. So redemption value will be 180 rupees. What will be the net proceed? So they say it is issued at a premium of 5%. So 5% of 200 is rupees 10, that means 210 rupees, and then 1% is the expenses. So 1% of 200, that is 2 rupees. So your net proceed per debenture will be 208 rupees. Put all these things in the formula, you will get the answer as 3.29% as cost of debenture.